How's everyone doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today we're going to be doing a review of the Federal Reserve's SLOOS survey. This is the Senior Loan Officer Opinion Survey. It's one of my favorite reports that I look at. It is a quarterly survey. So this is the report for July, which generally references the second quarter of the year. But before we get into the report, I wanted to go over this quick article from S&P Capital, which basically just reviews the report very quickly to give us kind of some of the highlights. And this is titled "Analysts Confident in Loan Outlook for Big Banks Despite Weak Fed Survey Results." So large banks are still well positioned on the lending front despite weaker than hoped Federal Reserve survey results. Piper Sandler analyst R. Scott Seifers said the Fed's Senior Loan Officer Opinion Survey, the SLOOS, on bank lending practices addresses changes in the standards on and demand for bank loans to businesses and households during the second quarter. Responses were received from 65 domestic banks and 19 U.S. branches and agencies of foreign banks. Respondents reported overall tighter lending standards for commercial and industrial loans, commercial real estate loans, home equity lines of credit, and credit card loans. Standards for residential mortgage loans and auto loans were basically unchanged. Loan demand was weaker for commercial and industrial, commercial real estate, residential mortgage, and credit card loans, but stronger for home equity lines of credit and auto loans. While the survey indicates that loan demand weakened and standards generally tightened at banks, Seifers is confident about his loan growth expectations for big banks, saying the lenders can absorb a slowdown in the second half and still meet forecasts, considering the bank's surprisingly strong loan growth in the second quarter. If second quarter strength continues, that would be good, and our expectations could prove conservative. Seifers wrote in an August 4th note, but if the SLOOS ends up being a precursor of slower growth in coming months, then our group's numbers should still be all right because of the conservative review with which we have already approached our expectations. The mixed trends in the survey occurred amid tariff-related uncertainty and the impact to the economy, though they do not indicate an impending credit downturn. D.A. Davidson analyst wrote on August 4th industry update. The analyst noted that following second quarter earnings results, credit trends were fairly stable, and management teams stayed optimistic about credit. During periods of uncertainty, it is not uncommon to see temporary periods where banks tighten underwriting standards, but it does lead to major credit corrections, the D.A. Davidson analyst wrote. Raymond James analysts are positive that demand for loans will ramp up over time amid legislative changes, favorable bank supervisory actions, government deregulation, and a lower federal funds rate. However, the Raymond James analyst noted the possibility of banks maintaining tight lending standards for commercial loans in the near term. This will likely be the case until greater comfort related to trade policy and its economic ramifications occurs, in addition to potential concerns around a weaker employment outlook, the analyst wrote in an August 4th note. And again, let's go to the Federal Reserve website here, which now actually has the survey. So just a couple things I want to say here before we get into a couple of the things here. So what were some of the things that we saw? Second quarter earnings results for banks were across the board were fantastic. Net interest margin actually expanded. We saw the expenses for deposits basically beginning to flatline as rates were remained pretty stable there. So what banks are paying out on interest expense still remaining a little bit somewhat elevated, but net interest margins were able to expand a little bit, which was great. The earnings were fantastic. Delinquency for the most part remained, very tame. Not really any major concerns there. Loan loss provisions continue to increase a little bit, which was nice because banks had kind of backed off some of their loan loss provisions in the last few quarters. And what were some of the other things we see? We have seen a weakening of the job market more recently here in the last couple of months, which is obviously we're going to keep a close eye on. And then finally, the Federal Reserve with interest rates. I believe that the key to loan growth dramatically picking up here over the next 6 months is the Federal Reserve interest rates. If the Federal Reserve is now starting to become more widely anticipated that the Federal Reserve will decrease interest rates in the second half of the year, particularly starting at their September meeting, If that is the case, and we do begin to see some 25 basis point rate cuts over the course of a number of meetings, bringing the rate down, what I believe anywhere from 1 to 1.5%, I think you will dramatically see loan growth, really pick up steam, especially in the fourth quarter and going into the first quarter of next year. And that would also help the labor market too. Obviously, if business sentiment is good, they go out, they're borrowing more money, they're getting that money. They will spend that money hopefully on buying more equipment, expansion, hiring new employees, so on and so forth. So you hope a lot of that will continue to play out. However, I do agree with the analyst from Raymond James basically stating that, we could see a tightening of credit underwriting, and we could see that remain at least in the short term. So I do not disagree with that sentiment. I think that tighter underwriting could last throughout the rest of the year. Until we see basically, we see that the labor market's not going to, implode, and we, continue to see a stabilizing of a number of factors. Obviously, tariff issues notwithstanding, things going on with that. So here is the actual Federal Reserve website. In the description down below, I have links to the website. I have links to the actual SLOOS report. And then I also have links to just the PDF chart. So one of the things I love about what the Fed does on the website here is that they actually give you the report itself, which you can click on the PDF button right here. Get the actual, so if I click on this PDF, I can actually get a PDF of the actual report itself, which is about 53 pages. We're not going to get into all that, but then also, I could click on just a chart here and I'll kind of blow this up a little bit just so everybody can see this a little bit. But here are 4 pages of just all of the main charts in the survey. So we can look at, net percentage of domestic respondents, tightening standards for commercial and industrial loans. We can look at net percent of domestic respondents, increasing spread of loan rates over banks' cost of funds. Net percent of domestic respondents reporting stronger demand for commercial and industrial loans. You can see that that's actually weakening, falling down below 0. Measure of supply and demand for commercial real estate loans. It's kind of, it kind of hit above, it came down, and now it's just kind of sitting there. Really, it hasn't really weakened much more than it had the last quarter or so. Net percent of domestic respondents reporting stronger demand for commercial real estate loans. That actually came back up, but then is kind of petered out a little bit. Measures of supply and demand for residential mortgage loans. Again, that popped back up, but then has gone back down a little bit there. We can see from the charts here. So again, just giving you guys an idea of what's in here and why I like some of this stuff. So you could go through the full 4 pages. But again, just to reiterate what was already talked about in that article. So, because again, I just want to focus on this first paragraph here, because the next couple of paragraphs just go into lending to business. It goes into the questions, and then lending to households goes into the questions, and then special questions on current levels of bank lending standards. And then it gets into all that. That's kind of boring stuff. We don't really need to get into all that, but let's just cut straight on this. So the July 2025 Senior Loan Officer Opinion Survey on Bank Lending Practices, otherwise known as SLOOS, addresses changes in standards and terms on and demand for bank loans to businesses and households over the past 3 months, which generally corresponds to the second quarter of 2025. Regarding loans to businesses over the second quarter, survey respondents reported, on balance, tighter lending standards and weaker demand for commercial and industrial C&I loans to firms of all sizes. Furthermore, banks generally reported tighter standards and weaker demand for commercial real estate loans. For loans to households, banks reported basically unchanged lending standards and weaker demand for residential mortgage loans on balance. In addition, banks reported tighter lending standards and stronger demand for home equity lines of credits. For consumer loans, standards tightened for credit card loans and remained basically unchanged for auto loans and other consumer loans. Meanwhile, demand weakened for credit card and other consumer loans and strengthened for auto loans. The July SLOOS includes a set of special questions inquiring about the current level of lending standards relative to the midpoint of the range over which banks' standards have varied since 2000. 2005. Banks reported that on balance, levels of standards are currently on the tighter end of the range for all loan categories. Compared with the July 2024 survey, banks reported easier levels of standards for most loan categories except residential real estate loans, for which levels of standards were comparable with July of 2024. So there you have it. That is the SLOOS, or the Senior Loan Officer Opinion Survey, for the second quarter of 2025. So we can see here that loan demand for, particularly on the business side, for C&I loans and commercial real estate loans remains weak, and credit standards have tightened in that respect. So again, love looking at this report. It's a great quarterly report that comes out from the Fed. I highly encourage people to check it out. Like I said, there is links to the report and the charts in the description down below. But with that being said, we obviously will continue to monitor. I bring you guys a lot of information on a lot of different bank reports. Continue to monitor all those, and I'll bring those to you guys as they continue to come out. But with that being said, I'll wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. Thank you guys for listening. Have a great day out there, and I'll see everyone again real soon. Thanks a lot.